You on kind of where we left off. I was pretty happy with the results we got last week when we were checking out the weekly iron. And a little bit torn. I halfway want to continue to check out what else we can do with that weekly because there's trades that I used to do that I want to bring back. But then on the other hand, I want to kind of expand beyond that and move into something else. So I guess before we kind of dig down into what that would look like, we need to kind of have a discussion about what other choices are on the table. So just for a recap, for those of you who didn't participate so far and what we've been working on, yeah, let's go to the SPX. I think it's a better choice anyways. So what we've been doing is having a discussion about this indicator that marks out the red and the green lines. It's a one standard deviation based off of the implied volatility on a week-to-week basis. We kind of beaten that up about as much as we could beat it up. We've talked it over, you know, discussed it from every angle I can imagine. Um, but things have changed since my strategy that I was using pre-COVID. Pre-COVID, the SPX only had 3 expirations in a week. Now we have 5. We literally have one every single day of the week. So that's one thing that has changed. Now I have run some strategies where we would focus on the Friday and we would look at the coming week and we would build the iron at each of those lines, one for Monday, one for Wednesday, and one for Friday. And the idea behind that is there has been many examples where the S&P on a Monday got to the edge of the expected move just in the very first day. And that's not too bad. As long as it stays inside the lines, we're gold, right? Because we're going to be looking at butterflies also, putting those butterflies on that line every day of the week. But for right now, we're still kind of kicking that iron around. And as you could imagine, if if this ranges for the whole week and we're putting it on a Monday, or excuse me, if we're putting it on Fridays for a Monday expiration, then it's going to have a very high win rate. But win rates in this context are not as important as how much money. Um, in the previous backtesting that we had been talking about, win rates were really important because of the no stop loss issue and the size of those losses. But generally speaking, when you're doing credit spreads and things like that, they have an inherently high win rate. And the idea would be that we manage the money in some way and they don't focus too much on the win rate. I know a lot of newer traders think that it's all about the win rate, but it really isn't. It's more about how much money you make when you do win versus how much you can avoid losing when you do lose. So I'm thinking we could run a back test on the every day of the week, right? Monday, Tuesday, Wednesday, Thursday, and see if first could we even get enough credit to make that worth our while, right? Putting on an iron condor on a Friday to expire Monday, I'm honestly thinking there's just not going to be enough credit there. And that when we do lose, the losses are going to be just absolutely horrible, and and it wouldn't be worth our time. But that's my assumption, and I don't have to assume. We've got the back tester, so we can just go in and build it and see what we get. Another point to be made is last week or earlier in the week when we were doing these, um, we've only been using 2022 data. And I've had a number of people say, hey, you didn't really go back very far. You only used this small period in time. Why is that? Well, we already had something that worked really good. And it has a historically amazing win rate. The problem is it doesn't work because of the conditions we're in. So it's not like we're trying to find a whole new thing that we're going to use forever and ever. Amen. We're just trying to find a thing that's going to work within the extremes that we're dealing with. And those extremes really kicked off at the first of the year. So back testing for 2 years or 3 years or 5 years kind of defeats the whole purpose of why we need a new iron condor. Obviously, the back tester could easily do that. And so, what I would encourage those of you who say, I didn't use enough data and that I should go back farther, by all means, get yourself a copy, go in and do it. But I already have a really good iron condor that I would normally want to use in good market conditions. And that's not what I'm working on here. I'm working on what we can use in the market that we have right now. And if we can't use it, what would be our criteria to avoid the trade? Some of the criteria that we've used to avoid the trade so far is a short week. So if it's a holiday week, we don't want the trade. Next week, an example is the 4th of July. So here it is. It's Friday. Normally, we would want to put the trade on a Friday for next week, but that would a no because next week is a short week. The other one that we use as an avoidance tactic is FOMC days. The week of the FOMC and then the following week, the week after the FOMC. And if you want to kind of visualize what that would look like, here is the FOMC announcements January, March, May, June. There are two lines because I mark the Tuesday and then I mark the Wednesday. And that's kind of for my own purposes. Obviously, you don't need to do that. You could just mark the Wednesday and call it good, but I mark them both. So we would have these dates eliminated, and then we would also want to eliminate any new ones that show up, of course, going forward. But this is a back tester, so we don't have to put in forward future dates. We just need to put in past previous dates that we wouldn't want. Let's fire it up. And just out of curiosity, let's put one on Monday, Tuesday, Wednesday, Thursday, Friday, excluding the dates that we had already talked about. And let's just see what pops up. I mean, who knows, right? Now I got to find the thing. I've been rearranging my pin bars. Had to play hide and seek there for a minute. All right. So we're using year-to-date extreme price weekly iron condors with blackout periods for holiday short weeks and cuts out the FOMC weeks, which is pretty nice. I was able to find which test I wanted to go back to because it gives you a spot to put your notes in. I love that. So because of our eliminations, we cut out quite a few weeks, right? And that's why there's only 13 trades. And I had adjusted the deltas a little bit to get us closer to the money, which ended up actually costing us one trade as a loser. But it significantly changed the capital. And for me, it was worth it. right? Because my goal wasn't to get this thing into a no loss state. The goal was to convince me that the strikes that we're using are going to work more than enough for me to be a profitable trader if I was to mechanically put this on every single week. And I don't just trade blindly. So once I'm in it, I'm more than capable of adjusting it, modifying it, doing something with it. What I want to use this for is a snapshot to kind of give me an idea. Am I even on the right track? So this is what we had. I want to go in and just adjust a few things. We're going to get rid of use exact day. And we're also going to add the other days of the week. It's still set for 7 days to expiration. We now need to perhaps consider margin allocation. When you first start Options Omega, I think the starting funds is like $100,000. Don't quote me on that. It might be less, but I think that's what it was at. So I dialed it back to 20K, have a more realistic portfolio. And then it's asking, well, how much did you want to allocate per trade? And when we were just doing one, 10% was a number that I was comfortable with. But now we're talking about having one new one every single day of the week. And that's going to be a little different. In fact, hold on, we may have to renegotiate this argument, right? Because we still want to continue to use Friday's expiration. If we tell this 7 days to expiration and the trade was put on a Monday, it's going to be looking to expire the following Monday. That's not the logic that we wanted to use, right? So we may have to approach this a little differently. Using exact days to expiration. Putting the trade on a Thursday to expire on Friday. And we'll leave everything else the same. All we're doing here with this question is asking, hey, if I put it on Thursday rather than Friday, would it still work? No, we drastically broke it. We most definitely do not want that. So let's let's knock that out of the window. Although not necessarily. I think we're doing this the wrong way. And let's if it was a Friday, we would be going for a Monday. Let's see what the dates are so I can make sure I'm getting the days right. Friday, April 29. And it's closing on a Tuesday. Okay, so we need to go back one more day to set this to a 3. $15 trades, 10 winners. Average day in trade is 3. This thing just bled money out. It's very likely because we're not getting enough credit for the size of the trade that we're putting on. But this would be that Monday trade. Using same width, focusing on literally the same everything. It's basically looking at these lines. And we'll just zoom in here. Today's Friday. So it would be like putting the trade on today using these lines and asking if we expire on Monday within these lines, and would it work? So that's what we're working on, because we want to do like Monday, Tuesday, Wednesday, Thursday, Friday, since we have those as a possibility now. At first blush, I would say that didn't work out too good. Let's see what happens if we adjust the profit that we earn. The winners went down, the losses went up. So that's definitely not making things any better. Let's see if we can adjust the strikes a little bit. So what I've been adjusting, if you're wondering what I'm doing here, the average red line in the current market environment has been landing at around a 22 to 23 delta. And so the idea would be, well, let's try to aim for those first. All right, hold on a second. I'm getting a little bit of news. Knock on wood, at least I'm not getting it knocked off the internet. Just got to catch the news on this. So if the 25s don't work, then maybe we want to try to dial it back. See, the whole argument here, and it may not be able to be done, right? Because the irons that I was doing, they quit working to begin with. My wife is being nice and getting me a mocha frappe from the local mom and pop store. Triple shot espresso. Yeah, that sounds good for a Friday. It's been one of those days. So if the lines aren't working in the current market environment, we've had 7 out of 10 breaches in the last 10 weeks. It may not be something that we can trade with these irons, right? In which case, we're just sitting here spinning round and round trying to figure out what size of an iron might fit in the current conditions and how much credit would we need to get for those. So let's back away from the irons instead, right? Let's just leave my iron with the weekly the way we set it up on Tuesday and call that good, because I think the Monday, Tuesday, Wednesday, Thursday, Friday thing is it's just going to be too disappointing. I can't see a conceivable way that we would get enough credit to be able to run those. So let's just move on to the next strategy. I've got 18 of these different strategies, right? So we don't have to get hung up on that iron. So instead, let's talk butterflies. If you are new to a butterfly, let's first get you caught up to speed so that you understand what a butterfly is. There is an old mantra that goes with these that says we sell the body by the wings. And that mantra used to drive me crazy because I couldn't understand what the heck they're talking about. So let me just sit here and build a butterfly real quick. I right click, go to buy, choose butterfly. And what you're going to notice here is we have the 3710, 3705, and 3700. $5 wide strikes. This is called a $5 wide butterfly. It's equidistant, right? So that's just a real fancy nerd speak for saying that these strikes are equally spaced. I'm going to zoom into this because I know sometimes in the zoom it's not so easy to see. So this gets us up close and personal. We can look at it a little bit better. So it's called a $5 fly because the 3705, which is the middle of this butterfly, 3705 and 3710, they're $5 apart. And then 3705 to 3700, it's $5 apart. We do two in the middle, short, and we do one at the top and one at the bottom, both of those long. And the way that it's taught is that mantra that we sell the body by the wings. So the butterfly, and believe me when I tell you I'm no artist, the the 3710 here, they would consider that a leg or a wing. And the 3700 down here, they would consider that a leg or a wing. So if you have a wing on the bottom and a wing on the top, and then you've got this uh, strikes in the middle, and that would be your butterfly, right? So they always say sell the middle of this thing and then buy the edges. But if you do this, think about what we have. So what ends up happening is that you have short and a long. So you have a vertical debit spread and you have a vertical credit spread built into this. And the 3705 is the fulcrum point for each one of those verticals. In a long duration butterfly, you have a reasonably decent chance of having a high probability, reasonably decent probability trade. But in a short duration, a butterfly is like a very low pop trade. Statistically, they win less than 20% of the time. And that usually freaks new traders out. They say, "Whoa, hey, no, there's no way I'm going to trade a strategy that loses 8 out of 10 times. Forget it. I don't want it." But you're missing it. The way that the options world works, when you run a low pop trade, the risk that you have to take is very, very small because you're the one taking all of the risk, right? You're taking a trade that says you're almost guaranteed to lose. And the options market is very fair and it's very balanced. If you're the one in the side of the trade that is almost guaranteed to lose, then your payout to get into that thing, your cost to play the game is going to be very, very low. And if you happen to win, your win is going to be very big in relation to that risk. So this trade, for an example, the one that I built here, it just hit zero, by the way. The SPX is a nickel increment options market. It doesn't do pennies. So we can't fill this butterfly for $1. the cheapest we could get is 5 cents, and that's $5. We couldn't get it any cheaper if we wanted to. But right now, if we tried to fill it, we would be getting it for 0, and you can't get it for 0. So we have to get it for at least 5. So we're going to lock that 5 in. And that would be the literally the cheapest amount that you could get. And if that means if we lose, it's going to be our commissions and that $5. That's all. So we're talking like $10 because options on the SPX, the commissions are kind of a little skewed, a little cockeyed. So you're talking $10 per trade. That's 10 pennies, options pennies. Now, granted, you're going to lose a lot. I mean, like, I got to find a better way to say that. You're going to lose frequently, but the losses are very, very small. And the wins, what would you get risking this $5? You get the potential to make near $450. Now, to be fair and realistic, your chances of hitting dead center bullseye are very, very, very slim. I heard a Goldman Sachs analyst talking about a butterfly once, and they said in 20 years they've never hit the middle. I felt bad for the guy because I hit 13 of them in 2020. A baker's dozen. Dead center bullseyes in 2013. And the way that I did it is the way that we're going to talk about today. Building my butterflies along those lines. Now, in the world of options trading, what are you doing down there? Kitty cat. My cat's crazy. In the world of options trading, when we circle back to this idea of fairness and probabilities, you have to realize the risk graph is going to show you all kinds of really great stuff, but you have to approach it with some rules that don't necessarily become obvious right away. What are some of the rules here? Well, one thing is, let's take it back to where we built it. So we're looking at the options chain. If 3705 is the midpoint and SPY was to fall all the way down to 3705, just for an example, that would mean that the 3710 is in the money. You can't have an option in the money at expiration because then you're going to have to deal with, assignment, even though it's a long option. If a long option goes in the money, your rights become obligations. Now we're looking at the SPX and there's no shares to assign and it's a cash settled product, but that kind of is beside the point. We wouldn't want to carry something into expiration. That's the main thing. So you can't carry a butterfly and hit a bullseye into expiration. You have to get out of it before the close. If you're using something like Thinkorswim, that's not a big deal because Thinkorswim offers you a chance to use an order called an MOC, which is really cool. Not a lot of brokers offer this. So MOC says, I don't care what the cost is, get me out of this damn trade before the market closes today. And it guarantees that you will be closed no matter what as we come into the end of the day. You may not like the price you get filled, but you will get out. So if we needed it, it's good to know that we have it, depending on your broker. Tasty does not have it, by the way. The other thing is probabilities, which is what I was talking about when the cat distracted me. So probabilities, the more occurrences you have, the more accurate your probabilities are. This should be common sense, but kind of think it over a little bit. If you are a bowler, this probably would make a little bit more sense, right? You don't have a bowling average just because you threw one game. Or if you do consider that your average, it's not a very accurate average because you only threw one game. But if you were to look at your bowling average over the entire season, then you would have a much better understanding of how accurately you bowl. It would be the same thing with options. So if we want to hit that win rate in the butterflies, that 20% win rate, we want to have enough occurrences to actually get a win. Some people do not like to lose. It doesn't even matter what it is. Walking in the mall, driving down the street, pushing shopping carts, whatever it is, they just don't like to lose no matter what it is. If you're one of those people, you probably just want to not trade butterflies because you're going to lose frequently. And this is one of those trades where you're going to lose 7, 8, 9, 10, 15 times in a row, and you're going to have to keep coming back and doing it again and again and again and again. And it takes a special kind of person to just keep coming back and losing again and again and again until you at least get one win to cover all of those losses. If you stop before you get one of those wins, then every one of those losses was for nothing. So please don't start a butterfly strategy like this and then stop. If you think you're going to stop, then just do it in paper and see if you can handle that. Otherwise, really, I mean, hey, you could get lucky and your very first try, you nail it and get a winner. But I mean, that's probably real unrealistic. So let's look at where the strikes would put us, right? And then have a discussion about the expirations. Now, when I was doing this butterfly in 2020, again, there was only 3 expirations that we could use: Monday, Wednesday, and Friday. In the new world, bum, ba-da-dum, we got 5 a week. And I was doing one on each line. So I would use where we closed Friday or as close to that as I could, right? Because I'd have to put them on Friday before the close. But I was trying to target that as much as I could. And then I would target the upper line and the lower line. So that was 3 butterflies on Monday, 3 on Wednesday, and 3 on Friday. Generally speaking, I tried to keep them all $5 a piece. And if I could make them bigger, and sometimes you can, if I could make them bigger and still keep them $5, I would. I would work the order all day Friday trying to get the biggest butterfly I could get for $5. And remember, you can't make it any cheaper than $5, right? I mean, that's like as low as it goes. So what it's going to look like is we want to sell 2 and we want to buy 1 and we want to buy 1, right? That's the way a butterfly is built. And I'm using those lines just because I suck at drawing and maybe it will kind of help a little bit. That would be the body. And then, you get that big butterfly wing. Oh, man. Quit laughing. It's not funny. That's a butterfly. Come on, y'all, you can see it, right? Maybe like a Brazilian moth or something like that, right? It's good enough. Sell the body, buy the wings, sell the body, buy the wings. Just keep that mantra all the time. Sell the body, buy the wings, sell the body, buy the wings. Our upper strikes, 38.75. So let's go in and build a butterfly at 38.75 and just see what it would cost. Right? We're not even going to try to make it wider or bigger or anything else yet. We just want to see what it would cost. $15. I would not take that trade. I would try to work the order. Already it dropped to 0 and now it's bouncing around again. I'd try to work it for $5. And if you're wrong, you're going to lose your $5 and then you're also going to lose your commissions. This is a good kind of strategy to use on Webull or on Robinhood, but you can't trade the SPX there. You're going to have to use the SPY. The good thing about using the SPY is that you very likely can get 1 penny butterflies. That's your entire risk. 1 penny, $1, no commissions. You could stack these things all over the place, right? And these are great for a small account. I know small account traders think this is crazy. No way I want to lose 90% of the time with my small account. But what if you're losing $1 a time and when you're right, you're making 40? or 60. So you lose 10 times in a row, you're down $10. You hit one win, you're up 40. Take your losses out of that, you're still up 30. Anyways, this is a Friday butterfly. We would want one for Monday, Tuesday, Wednesday, Thursday, Friday, and we would want one for the top, the middle, and the bottom. That's a lot of butterflies. In the SPX, 3 butterflies at $5 a piece is $15. Um, Commissions is basically $5 per butterfly. So you're looking at 3 butterflies, $30. 5 days, that's what, $150? So you're looking at $150 a week until you hit one. And that's if you're building all of them $5 wide. Or yeah, $5 wide, because there's no strikes in here for $2.50 wide SPX. So time to get into nerd mode. Let's go in and build a whole new back test. And the good thing here is it doesn't matter if we're using just 2022 or even farther back. But we do have to try to identify where we're going to put the butterflies, because this back tester does not have the expected move in any way, shape, or form. Not yet. I'm hoping someday. And our blackout days, hopefully that doesn't delete all of those. Oh man, yeah, it does. Ooh, someone add that to the request page, right? Don't delete my blackout days when I turn the blackout days off. That sucks. Let's cancel out of that. Well, we can get them back, so it's fine. They're not lost. Remember, I saved them last week, anyways. All right. Well, we got a little bit of an issue here. If we use delta to pick the body, it wants us to also use delta to pick the wings, rather than using, say, strikes like we were on the iron condor. Right? Let's go back to the iron condor for a moment. You see how here it just says plus or minus, and that's giving you a chance to basically go how many strikes higher or lower that you want to land after you pick your first strike based on delta. But when we come over to the butterfly, we don't have that same choice. Now it's pick your delta, and we're going to also pick your other strikes based on delta. That's going to give us crooked butterflies, unbalanced flies, or broken wing flies. Kind of call them different things, but they're not going to be equidistant apart, and that's going to break the whole thing. I would say, looking at this, that I don't know anybody who builds a butterfly basing the wings off of delta values and not based on equidistant strike values, and that this butterfly backtest is absolutely, completely, utterly worthless. Even if I was going to do a broken wing butterfly, I would maybe choose the broken wings based on deltas. Maybe. And at which point that would be in some way valuable. Let's see if we can manually build it and run it, since the selector isn't going to work for us. Nope, it automatically defaulted to delta. Well, that sucks. Maybe we can break the iron condor and use it, because the iron condor has the parts we need. We'll just break that. There's the 3 strikes. Make them all puts. Make that a sell, that a buy, and that a buy. Haha. See, we maybe got a way around it. I think I did that wrong. Let's do it again. All right, so we need to get rid of this top one. I'm very sure it's going to link the other direction, though. Dang it. Okay, we can do that. We'll leave it on there. Just leave it at 0. Now, all puts. Buy that, sell that, buy that. And we want 2 of those. Haha. So we got there anyways. Hopefully, we'll see if this works. Before we go in and change a bunch of settings and play around with everything else, let's just see if this will even run. Because if it doesn't, I don't want to waste a lot of time messing with all the parameters. See, we're getting an error. We may be getting that error because of something else. But I would bet that it's because we have a quantity of 0 here on one of them. Let's just... Do we have sufficient margin? Yeah, it's a cheap butterfly. Did we use exact days to expiration? We did, so we can try to turn that off. And we didn't mess with VIX or TA entries, so none of that should interfere. Still won't work. All right, so maybe we can't do butterflies. I can certainly try. My concern, I see that it gives you that, but see the way it works is this leg is attached to this butterfly, and so it knows to go 10 strikes away. If I did get rid of it and we tried to use this as the body, that wouldn't be linked to it the way that this one is linked to it, right? That's my concern, but I'm still willing to try. You know what I mean? Like it can't hurt. So we'll try it anyways. Exactly. Yep. But let's just try it. Now, see, as soon as I killed that top one, it took it, right? It took both legs. Now we can try to add a leg. The other we need to add it the other way. Let's do it again anyways. 1 2 1, and we want to nah. Urgh. It's floating by itself. Yep. Now that is a request that I put in, oh, probably about a month ago. So the only thing that we can do is unbalanced butterflies, which don't get me wrong, I like an unbalanced butterfly. I do. Um, let's go back and kind of talk this out for a minute. We won't be able to back test it the way that I wanted to back test it. We're going to end up having to do broken wing butterflies. But in 2020, I ran this strategy. Monday, Wednesday, and Friday, I ran this strategy. I only missed one week out of all of those. And I had an 85% win rate, 13 dead on perfect bullseye butterflies. And then I had extraneous wins from different sizes, a whole lot of losses. But at the end of the year, I made a lot more than I lost. And I don't remember the exact number. I'd have to get my spreadsheet out because I recorded every one of those trades back then in the spreadsheet, what my premium was, my strikes, everything. It was a busy year in 2020. The strategy works. But let's kind of go back for, since we can't do that yet, let's have a little talk about this butterfly because it is something that I really want you guys to consider as a viable trade strategy. Even though it loses more often than it wins, those payouts, oh my God, they are just wow. Now remember, we can choose to have a butterfly every single day of the week now. And what I want to just do here is we're going to zoom in a little bit and let's think about how many of these would have been a winner. At first glance, that looked like it would have been a winner, but I would argue that it's not, right? It's not because we ended the day farther away from that red line than I think is viable. Viable would be within one strike, maybe two. So we're talking it has to hit within $7 to $10 from that line or it's a loser. And this is 46.96 and the midpoint, we actually wouldn't have our butterfly on that midpoint. So let's zoom in a little more. Think about where the butterfly would end up. It's always on a 5. A round number like 41, 46.90 or 46.95. So we would have been closer to 46.90. We would have been way down here, and that closed way up here. So That was $5 away. It's very likely that that would have been a loser or close to a loser. There might have been a slight amount of profit, but probably a loser. This one as well. Now, if you're thinking, well, we had some point in the middle of that day to close it, that is true. But here's one thing that I learned about butterflies in the very short duration. They're almost worthless until the last day within the last, say, hour and a half. So if you put a butterfly on a Friday and your expiration is next Friday, on Tuesday, if price gets where you want it to be, you probably won't have any profit. And the sad thing is you'll see price exactly where you need it and you can't close it for any real money. That sucks. So then, by Wednesday it's already moved and then it's no longer at your spot and your butterfly ends up losing. It's saddening, right? But on the day that your option is going to expire, after you get past lunch, so around 1:30, you're getting into 2 o'clock, if price gets in that window, you start to see profit. The bigger the window, the better. So we can make them $5 wide, but if you can get away with a $10 or a $15 butterfly and you can still open it for 5 cents, you definitely want to do that. Make these things as big as you can because it widens out your profit window. I talk about your range to be a winner. If your trade is $5 wide, your range is basically $10 because it's $5 on each side. So if we'd have built it at 90, then 95 to 85 would have been your window for being profitable. And if it doesn't land in that window in the last hour and a half of the day on the day of expiration, you won't win. So it's not just being in the right spot, it's being at the right spot at the right time. And that's a lot harder to do, except statistically, price pins to the lines on this indicator way more than it statistically should. That's what got my attention to even try to trade the butterflies using this thing back in 2020 when I built my strategy. So on this Tuesday, for an example, now we can zoom in and get really tight on it, but I would argue that this would have been a pretty good payout butterfly. It may not have been dead on perfect spot awesome, but it would have been close enough that 150 or $200 is not an unrealistic profit target there. So we would consider that the first one out of all of the year to date. That'd be like 20 days at that point, right? Maybe 30 days because this is February 2nd. And this year we've been breaking out of and closing out of these lines more than we should. So right now, the argument could be made that you would actually see more losers right now than normal, but you would be getting some bullseyes. Monday, we could argue about how much money that one would make, but look at Fridays. That's that's pretty darn amazing. Now remember, you can't build a butterfly on an odd number. So when we zoom in, it would be asking the question, did that close on the 5 or the 0? No, it closed on the 4. $1 away from the $5 strike. Dang, that's pretty accurate, right? That would have been a couple $100 right there. I know that this may seem very tedious when it would be so much easier if we could just accurately test it with the back tester. But here's the thing, they're constantly working on that. I've already put in the request to be able to do uh, leg choices on a butterfly based on strikes and dollar values rather than strikes in delta values. We just have to wait them out, right? They're constantly making updates. They're constantly making it better. Let's give them the time to make it better. We can do other trades. There's still more that we can backtest using this indicator. So since we're already on the theme of a butterfly, let's talk about another butterfly. And this one's called a broken wing butterfly. When I was doing a presentation at the Benzinga Options Boot Camp, I went and I represented the Bullish Bears there. They asked me to bring one of my favorite trades, and I wanted to do something that everybody else wasn't doing. Like verticals are all the rage, iron condors, everybody loves them. So I wanted some odd topic trade, and this is the one that I took. On Thinkorswim, it's called a butterfly, but how I got this butterfly, right click, go to buy unbalanced butterfly. This is the only place I've ever seen it called unbalanced. Anywhere else, it would be called a broken wing fly. Or excuse me, it would be called a ratioed fly, not a broken wing fly. The reason that it's called a ratio everywhere else is because the ratios have changed. A regular butterfly is a 1-2-1. This is a 1-3-2, meaning we changed the ratios. So I don't know why Thinkorswim calls it unbalanced when it's supposed to be a ratioed butterfly, but you really got to watch that close, because if you go somewhere else and they say that it's a unbalanced butterfly, they probably mean a 1-2-1, but that the legs are unequal in their distance. So we don't want this 1-1-3-2 yet. We don't want to look at that one. Instead, we want just a regular butterfly with one leg farther away than the other one. So remember earlier we had $5 wide between each strike. And if we threw it into the Analyze tab, we get that that tent, right, with a midpoint and then flat edges, and it's $5. But instead of it being $5 wide on each side, we could actually break one leg off and take it farther away. 5 is the midpoint, 10 is the top side, and 3,700 is the bottom side. So let's move the 10 and go to 15. See what happens. Make sure you unlock stuff. So if you see what we have here, that is not what we want, right? Price is way up here, and this thing would only be profitable if price went from here and fell all the way down there and got on the other side of that break even. That is absolutely not what we want. That is perfect. Yep. So let's get rid of that and put the 5 back to the 10 and move the other one, 3,700 flat, knock it down. And now look at the shape of this thing. So we're going to zoom out a little bit more. And the first thing that you want to notice, or that you want to look for, is where is the current market? The current market is right there. Where's the break even? When does this trade start to lose? All the way down here. So as long as the S&P stays above 3,700 between now and July 8th, this will be a winning trade. The minimum win on this is the 90 cents credit that you get to keep. Now I say minimum, but that's not a fair statement, because we could fall all the way down, go past the peak, get really close to the break even, and then come back up a tiny bit, and it would be a small win. So that wasn't exactly a fair statement. but still we would focus on it and say we're more likely to get a dollar credit than we are to get this big tent down here. Now, why is this a better trade than just doing a vertical, an out of the money vertical? The beauty of this trade is I'm going to go in and I'm going to build a vertical and we're going to bring it back in. We're going to sell 37.05 and buy a 36.95. And I'll show you what that risk looks like. I might have the wrong numbers, but once we have it in there, I'll get the numbers right. 37.05 and 36.95. All right. So if we get rid of the butterfly for a moment, we turn that off. Let's just look at the credit spread that we have here. It's $5 wide, so you're risking $3 to make $2. And as long as price stays above your break even line way down here, you're fine. You're going to win. But experience says as soon as you put a trade on like this and SPY goes down even a little bit, if SPY starts to go in your direction, this trade is going to start to lose. And you won't know if you should close it or not. So you're going to be holding it thinking, man, I don't know. This isn't feeling very good. I'm down 100, down 150. This kind of sucks. Should I close it? You won't know if you should close it or not. And as long as it doesn't cross 3,700, you're going to win. But you'll be in a loser for days and days, not knowing if you should close it. And if price comes all the way down but does not break through your strikes, you will eventually be a winner, but you're going to be miserable the whole time. And then you can't size up because then the loss gets really bad. And this just it can't take any heat whatsoever, or your trade starts to lose, and you just don't know if you should close. So that sucks. But if you take that same trade and you put it in a butterfly like this, now if price begins to fall towards your position, because you have that butterfly there, your trade does not immediately go into a losing negative position. Now here's the bad part, right? Nothing is free. This has a bigger loss. So if you did lose, this one's going to hurt more. Also, look at the credit difference. The butterfly is going to give you a dollar credit. Just a regular vertical is going to give you a $2 credit. So the butterfly potentially has a bigger loss and less credit. And if you're thinking, well, why the heck would I want that one then? Well, if we're going to do a broken wing like this, or yeah, a broken wing, we can change the midpoint. Instead of being at 3,700, we can go a lot farther out than that. And it would still have credit to the upside. This is really good for those people that want to put on out of the money credit spreads and they want to get really far away from price and be able to sustain the trade. That's what a broken wing butterfly will give you. Having said that, they hurt. If you go and start building them big and then you get ran over, it's a painful thing. They can be broken apart and scattered into the winds. And then, you can spend the next 2 months trying to fix the scattered broken pieces. But we want to try to avoid all that if we can. So there is a thing called a 3 sigma move or a 2 sigma move. If we think of the size of the box as a 1 standard deviation move, what would be a 2 sigma move? It would be taking that box, doubling it, and then asking the question, how often has price gone more than a 1 standard deviation or more than a 1 sigma move? How many has it made a 2 sigma or a 3? I would say that we almost had a 2 sigma move not too long ago. We've been getting some pretty extreme moves. We would still need a way to be able to put that into the back tester. $95, 5, and 1. Let's see what that puts us. 95, 5, and 1. So 36.95 is a 20 delta. 705 is a 23, and then a 24. So let's go back to here. Delta. So what I've got is a 22, a 25, and a 19. 1, 2, 1. This should kick us out. Don't hit the enter button. I keep doing that. And what this should produce. Oh, I should have left it alone. That looked really good for a moment. It should produce strikes pretty close to what we want. So I'm going to kind of just zoom in here. I know it's a little rough on the eyes. 60, 65, 75. That's pretty close to what we were working with. Might have to knock it back a little bit more. We definitely want to make sure that we never get a debit. This one, for an example, was opened with a debit. We would never want that. Let's go back here. Yeah, $10 and $1. All right. We're moving in the right direction. Only for a credit. I guess we should have looked at how many or what the credit was. Let's just say 25 credit to start with, just to give it a ballpark. Right? We don't need a max, just a min. And what that's going to do is eliminate that debit one that we saw there. So 4 trades, because it's only doing Fridays, and 7 days to expiration. That's not, oh, we can't do it that way. So we're going to have to do every one of them by themselves. We got to do a 7-day, a 6-day, a 5-day. So while we're waiting on that, let's just come in and look at here. These are obviously not right. 5 days in the trade, all of them were winners. I never trust anything that says all winners. Use exact days to expiration. Change the profit target to at least 50%. Whoa. Yeah, that destroyed everything. What I'm sitting here looking at are these P&L values. Opening the trade with like 60 cents worth of credit, closing cost 15 cents. Now, this still has a lot of the other criteria that we were using. So the slippage is still in there. And we made it a pretty extreme slippage before when we were messing with those irons. I'm going to knock that back a little bit. We're still ignoring trades with a wide bid ask spread, which is why one of those are scratched out, the March 4th. So that increased the number of trades to 6, and it's still showing 6 winners, which I never like a back test that paints me a rosy picture, right? It always makes me a little nervous, like, yeah, come on, sucker. But what I love about this back tester is it shows you what the trade would have been. So you can go in and on Thinkorswim, you can recreate that exact trade. Now, Thinkorswim uses end of day data, but if you already knew what the premium was when the trade was opened, you can put that in, and you have that with this information here. So if we wanted to, we could take Thinkorswim back to January 7 and build this butterfly with that credit and watch and see how it unfolded. Some things that we want to be aware of. These trades were closed 1 week later. No, excuse me. I said that completely wrong. This trade was closed in the exact same day. That's odd. So was the next one, and the next one, not this one. This one actually made it to Tuesday. But the first two butterflies, those were 0 days. They were done in and out on the same day. There's a Tuesday, a Monday, a Tuesday, a Monday. So yeah, interesting. Let's see if we can bump that target profit up a little bit. If we're getting trades closed in the same day, and we want to see if we can get more out of it. So far, so good. It's not really making a lot of money, right? I mean, average trade, $100 here, $100 there. I'm not really upset about that. We can scale up a little bit, from that point of view. It's a real crazy market right now. I wouldn't want to put too many eggs in one basket, so to speak. But all right, I've been slowly walking this thing up. Let's just get wild with it and try a pretty high number. Still not impacting us. All right. And now we've seen an impact. So we'll back it off. 80 something percent was too much. 65% seems to be all right. And again, remember, it's not like we're trying to build a zero sum game. We know trades lose no matter what the backtester says. Sooner or later, you're going to get a loser. And it would be because you get an outsized move. This thing is just telling you you haven't had an outsized move big enough in 2022 to have gotten whacked, right? It's not saying you would never lose. With a 65% profit target, based on the amount of credit that you collected in the first place, one of the things that we may want to do is increase the profit. But notice how the P&L is not reflecting the premium collected. So when we're telling this thing that we want 65%, it's not saying that we want 65% of the credit that we opened the trade with. It's saying that we want 65% of the profit off of the maximum profit value. There's a big difference between those two things. To kind of give you that visual so that you understand, because I get it, that might sound a little complicated. Here is the iron that not the iron, the butterfly that we're building is in this shape right here. And if we were to open this trade for a $1 credit, normally you would think, oh, well, I'll just close it for 50% of that credit, 50 cents. But what the back tester is saying is this has a maximum value of about $500. And we're trying to get 60% of this value, not 60% of this value. Right? Does that make sense? So that's why the profit is better than just looking at those credit spread values. Because remember, in this $2 credit spread, the most that we can make is $2. But in this butterfly, the most that we can make is that max profit based on the peak way up here. What do you guys think of this butterfly? It's called an unbalanced. No, unbalanced is on Thinkorswim. This one doesn't have a name. It's a broken wing butterfly. You'll have to manually build it on Thinkorswim. Well, what do you think? The numbers are certainly there. And this one is still using all of our blackout dates. So, well, I said that, but let me check to make sure we actually still have those blackout dates. Nope. So this did not account for any of our blackout dates, which means FOMC, holidays, the works, all of them. Technically speaking, we could put it on today because this thing worked just fine without any of our blackout days in it. So the criteria, what I'll end up saving this thing and let me run it and then we can save it. I'll end up saving it, taking screenshots of it, um, putting it into the backtester Discord. Create a new back test. This was saying unbalanced. That ain't right. It's not unbalanced. If you do unbalanced on Thinkorswim, it's going to give you a 132. Broken wing butterfly. Now I can't share these the way that we would share like a Thinkorswim link. I can't give you a link, but I can certainly take pictures of the all the settings and put them in the chat. Now, we only ran it year to date for the moment, but when I'm done with these pictures, we're going to expand the dates and see if it would have worked just as good when we were not in such a violent market that we are in right now. I know a lot of people get hung up on like gex and dex and what the vix is and where's my moving averages and the macds and all of that. I get it. I'm never going to try to talk someone out of using that kind of stuff, right? I mean, if that's what you want to use, by all means, make a determination of when you think it's good to get in based on some indicator, if that's what works for you. Just keep in mind, when it comes to a lot of the things that we focus on, especially the market like the SPX, the indexes, these things are going to respond to CPI numbers and the Fed speakers and what's going on over at the European central banks. It's not going to be based on what your RSI is on a daily chart, right? That's not what's moving us on a day-to-day basis. So from when I go to approach a trade idea like this, especially in the indexes, a mechanical system, as far as I'm concerned, only needs to use the Greeks themselves and time, because none of the other things that we would ever consider, like a momentum indicator or a trend indicator, has no bearing on the indexes. They're mean reverting products that are directly affected by economic events and Fed speakers. Now, granted, their impact isn't always as felt like it is in the current market, but still, I would say that they are more impactful and insightful than, say, a MACD or an RSI or something like that. So I'm adjusting this thing to look at the last 2 years just to see, like, what if? Would it have changed our impact? So a couple of losers in there knocks the win rate down to 85%. We had a max loser of 1326, and this didn't have anything in there to shut it down because it was still based on the old strategy that we were doing. So let's add an exit metric. All right. I don't like stop losses. So that's not an exit metric that I would want. But it does have something about when the short leg is X amount from the underlying. So now that doesn't quite fit because it's not the short leg, right? It would be, we don't want that one. That's going to kick us out of trades, good trades. Let's try, you know what? We may have to use a stop, even though that's not necessarily the way I would approach it. Let's just put one in and see. Try 65%. Wow. Adding that stop killed almost every one of our winners. No surprise. It's a reason I don't use stops on these kind of trades. Stops will do a really good job. They will kick you out of the trade. So Remember that these are a snapshot, right? And we know that 18 of these would have been a winner. Let's just game out for a moment what we would do it with a loser, because we're not, I don't think any of us would just blindly sit there and watch it lose and say, well, the strategy says, if it was an obvious loser. So what would an obvious loser look like? Well, here's the shape of the trade that we're discussing. I think the argument could be made that if you put the trade on a Friday and you're way up here, and at some point between your Friday and the next Friday, price falls all the way down here and beyond your break even, that you would probably have done something at that point, right? Even if it was to close the trade early or roll the strikes or, for goodness sakes, do something. I manage trades rather than just closing them. So maybe at the very least, perhaps closing down part of the trade, right? Or just killing the entire thing based on price. If it was to breach the break even, for an example, that would be a mechanical way to just kill the trade. I would put that in to the back tester, but I don't have that choice, right? Let's see if there's some other thing that we can use, because the short leg isn't going to work. That's the middle of our butterfly. We don't want that choice. And if we don't find anything, I'm still okay with this, because the idea would be we can visually see when price breaks that break even, and we can just use that for our exit criteria manually. Heck, you could set it your exit there. If price breaks this, get me out kind of thing. You just wouldn't be able to back test it. Yeah. So if you think about strike price shift differential, these out of the money options, let me get the right ones. We'll just copy this and take it with us. That way, if we've made any adjustments, we're looking at it. So that 36.95 right now has a delta of 18. And if that delta goes to the money, it would be 50, right? So we could use something that says, if this delta goes to 50, get me out of the trade. If it has that choice, right? Because that's really what we would need it to do. But see, it's not offering me a lot of choices. So where, I guess I got what you're saying. If the short leg, it's not giving a delta value, it's only giving a dollar value. Still, I guess we could try $10, right? 10 points. What's the worst that could happen, right? So the number that we want to focus on is, we're still going to have the same number of losers. We wanted to see if we could get the dollar value of those losers to be smaller, right? Because adding the stop or adding some kind of exit for losers is only going to help us get out of it, but the loser is still going to be a loser. So we need to see what it was and then add that back in again. I didn't even turn it on. So here's the original numbers: 1326 or 1316. Now we'll turn it on and see what we get. Oh yeah, that significantly reduced the max losses, but it also kicked us out of some good trades, right? We have fewer winners now because our stop or our protection from loss is kicking us out of good trades because we're still using the center of the butterfly rather than the lower leg of the butterfly. It's better than nothing, I guess. The main thing the takeaway for me here, and I'm going to turn that thing back off because I don't like that criteria. My takeaway from this is that if we manually choose to exit the trade, if it breaks the break even on the downside leg, you're going to get losses from time to time. But I bet the argument could be made that you've got more money there than more profit from the wins than you have from the losses. But I want to see that. You know what I mean? I want to have that ability in the back test. So it'll take me a little while to write this request up, but I'm going to add this to the request over at Option Omega that we need a way to define an exit based on more than just the short leg, right? Because in this case, the long leg is what we would want to use, and we don't have that choice. And it makes sense. The reason that they have that criteria on there, if you think about if you built a um, a credit spread and then your short leg of that credit spread went in the money, that would be concerning. You'd probably want to manage your trade. So that makes sense. We just need more choices so that we can add something else. Let's go ahead and increase this. Let's make it something a little bigger. 25%. I see it. It's no, that's screwing us up because it says plus or minus. If it was just plus or just minus, that would be better. Unless I can find a way to, is it negative? Well, you know what? Let's try it. Maybe it's just plus, and then if you wanted it to be, it could be a negative. We got some of our winners back, I think. Certainly cutting out a lot of our winners. But this is not unusual. When it comes to mechanical systems, there's always two pieces of trouble that are endless in their grief. One is how am I going to manage the trade to get out when it's not working? That's always one side of it. And then the other side is what can I do to eliminate losers? Anything that you ever try to do to add a filter to something to eliminate losers, it will always also cut out winners. It's the name of the game. You cannot cut losers out without also sacrificing winners. I've never found a way to do it. And usually I'm more willing to take the losses that are there rather than try to cut them out because it would also cut out too many wins. But that may not always be the case. So we didn't really get where I wanted to get this week on these, but the choice selection isn't there to run the butterflies that I was running, and we're going to have to wait to get those results. The good thing is they've added more products, and that old Russell a lot of times doesn't move as much as the S&P. When we're talking about putting on trades like the iron condor, an argument may be made that perhaps the iron on the Russell would be a better choice. But consequences, if the Russell doesn't move as much, it very likely has a lower IV, and that means we're going to get a lower amount of credit per trade. But it does give us something to think about for next week. I'm going to get a write up done on a request for different exit conditions. on your own, if you're thinking about this trade, let me share with you some ideas that I have used before for exit conditions. And it's not automatic. I do not put in like stop loss stuff, but I do set alerts to things. In the trade that we've been looking at, 36.95 is the break even, and that has a delta of 17. On Thinkorswim, you can right click and you can create an alert on delta. And what you can do here is ask this thing to warn you if your delta increases by X amount. The logic behind this is delta is very often used as a probability of out of the money. So when we're looking at something like the 39.85 or whatever, 38.95, when we're looking at that number, it has a 17 delta that has a 17% chance of actually closing in the money at expiration. If that probability increases, say, by 100%, that would mean that your risk increased by 100%. That is a number that should get your attention. Doesn't mean you'd have to run right in there and close the trade. It would just say, hey, like your risk just doubled. Doesn't that cause you any concern? So you can right click and then say double this number. Instead of it having it say 17, make it 32. If the delta goes above 32, then you'll get an alert and you can fill out the note. This thing will text you, it will email you, pop up on your smartwatch. It'll do all that kind of stuff. Play a noise on your computer, whatever you want it to do. At the very least, this would give you a warning that, hey, your chance of losing just doubled. That's concerning. So that's one thing you could do. The other one would be to set a price alert. So you could go out to the chart, you can right click on the chart, set the price alert, and then, give yourself a warning. Say if price gets within 10 points of your lower strike, that it would give you a warning. Me, I'm looking at the SPX every day. So I don't need this thing to tell me, hey, price is pretty close to your strikes. Thanks. I already knew that. I'm looking at this stuff all day long. So I don't need that one. But maybe, you got a job, you're not sitting there staring at the charts all day and you want that nice little heads up. That'd be another way to go. And I think that either one of those would be a better choice than putting in some stop loss value that is very likely going to get you kicked out of a really good trade. So that's what I got for you guys this week. If there's no questions, we'll wrap it up. Now on the YouTube, I can see that WY mentioned that we could have perhaps done an iron fly, and he's absolutely right. That's something I didn't think about. Um, Before we call it quits, let's see if we can. That way on Tuesday, I know what we're going to be doing. You can bet on that. So let's just try it, right? Go up to iron fly. And sure enough, the strikes are moving by dollar values instead of delta values. We're picking the first strikes based on the delta values. We need the call and the put to be in the same location. I don't know if we can get away with. We can't do it that way because these are built so far out of the money that you would have calls so deep in the money that it would just be completely crazy, right? Unless we do it that way. Hey, nothing changed, so it's still fixed, right? That's a good fix because instead of just having the calls there, we just put them over onto the put side. Nice. That's a nice fix. Thank you, sir. So from here, say if we went to 25 and set this to 25, then start dropping these out in each direction, 5, would it work? That's kind of the jam, right? If it does, I know what we're doing Tuesday. Nope. Got some kind of error in there. I wonder why. We'll look at it. So it's something to think about. We'll check it out and see if it works on Tuesday. Otherwise, hey, everybody, have a good weekend. Be careful on the 4th of July. Don't donate any fingers. I'm already shorthanded, so I'm not giving any away. That's for sure. And I will see you all Tuesday.